That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us now with the latest market action. Jared.
Thank you, Josh. Well, in the Dow, you can tack on almost 600 points today. That's 588 to 46,067.65. That's a gain of 1.3%. Nasdaq up a full percentage point greater than that, almost 500 points, 2.21%. And the S&P 500 up about 1.5%. And by the way, this is the best day for the S&P, Nasdaq, tech stocks, and chip stocks since May. And that's coming off of that worst day that we've seen. That would be Friday since April. So what a turnaround here. And in sector action, all we're seeing in the red here is staples and healthcare. And then leading the pack, we've got tech that's up almost 2.5%, followed by consumer discretionary. Big Tesla move today, then materials, all three of those outperforming. And let's skip over to the Nasdaq 100 to see some of that outsized performance. Nvidia up almost 3%, Alphabet over 3, Broadcom up almost 10% off of that deal announcement, Tesla up 5%. And if you take a look inside the chip stocks, you can see a lot of dark green there. And some of the leaders here, besides Broadcom, ARM up even more, 11% today. And don't count out Taiwan Semi, that was up 8%. Just taking a brief look at software, we see Oracle up 5%, CrowdStrike and now up more than 3% along with Datadog. But let's check out China. And we saw a lot of action there. Baba came roaring back up 5%, JD just behind that, Baidu up 3%, list goes on. And I will leave you with a look at the Dow where we got a little bit of red there, some of those healthcare and staple stocks in the red. But for the most part, we're seeing, check this out, JP Morgan up 2% ahead of earnings tomorrow morning. So we will be on the look for that. And I'll send it back to you, Josh.
All right, thank you, Jared. Well, stocks recoup some of Friday's hefty losses, relief on tariff talk, and a boost in AI demand, optimism helping stocks stage a comeback here. David Stubbs, AlphaCore Wealth Advisory, Chief Investment Strategist, joining us now to break it all down. David, great to see you. So green all over the place today, David. That is a 180 from Friday when we had the freak out. I'm just wondering for investors who are listening right now, David, they look at this and I'm sure they're wondering, is there a lesson here, David? Do you think is there a takeaway from this?
Well, good to be with you. I think the takeaway is a classic from investment strategy, which is the best days follow the worst days. And if you get shaken out of the market, get shaken out of the stocks you like, the themes you like, the countries you like, in the bad days, which will inevitably happen occasionally, you miss those big up days. And I'm sure that your watchers have seen those charts where they break down the total return of the market over the last 5 years, 10 years, 20 years, and then remove the impact of the best 5 days, best 10 days, and it's a huge impact. And I think you see this market, like any market, is vulnerable to headlines from key policymakers. I think that vulnerability, as laid out by a previous guest, was particularly high because you do see some crowding in markets today. You see some markets that have come an awfully long way off their bottom. Valuations are a little high, so again that increases fragility. But I think the big takeaway, going back to your original question, is good days follow bad days, and this is why you want to maintain a long-term view.
Speaking of those U.S.-China trade tensions, David, here was Ed Yardeni, Dr. Ed, smart guy, right? Here's what he was telling clients, speaking of those tensions. He says, given the severity of the consequences, we expect a quick de-escalation of the tensions with both sides willing to negotiate. Is that kind of generally your take on this, David, as an investor? That listen, there can be headlines, there can be social media posts, there can be a lot of aggressive huffing and puffing, but at the end of the day, there's just too much on the line, and there's going to be a handshake and a deal.
I think broadly speaking, yes, that's the way we are approaching this. But I think that also maybe underplays somewhat of the particular difficulties with this relationship. I think the market has been through the ringer here. In April, of course, we had Liberation Day. And since Liberation Day, you've had basically only good news out of trade. You've had some key deals. And you've also had the most difficult negotiations, like the one with China, pushed off for 90 days at a time. But ultimately, the rubber has to meet the road somewhere. Now, as you laid out, the incentive of both sides here is to do a deal. and not disrupt their respective economies. But there are some very big issues on the table, some very significant statements on both sides, two countries that are vying for supremacy. And I do think we're going to get an awful lot of headlines, even if it does, tend to work out okay. And of course, the threat here of these very large, tariffs on one side, from the US acting almost like an embargo around crucial components, and then the assertive stance from the Chinese on things like, rare earth metals, does portend to the pain that both sides can cause each other. And even if that pain turned out to be temporary, it could still be quite disruptive. So I think we're going to have to live with this risk for quite a while, but investors are usually best to see the big picture and focus on the fundamentals of companies.
David, as investors, obviously, listen, we're focused on earnings. We're now headed into the thick here of earnings season, banks on deck. What are you listening for during this earnings season? What do you expect?
I think the market, we know what the market's going to be focused on. It's going to be focused on CapEx around AI and how big that is from a handful of those large hyperscalers. I think the next level down there is really what we're going to be mostly focused on. Which companies are actually deploying AI for material benefits to their firm, either stripping out costs at the back end or improving customer service at the front end. So I think that I'll be looking for evidence that AI is being deployed to boost margins in all types of companies. Financials are a great example of this. They have the two things which really power AI. They have a lot of back-end costs and automated processes that can be improved. And they also have a lot of proprietary data lake, as it were, that they can use AI on to improve their understanding of their own customers. So I'll be looking for that, that end market, the people who want to buy the AI, the people who are able to use the AI to improve their own companies and drive their financials. That's going to be the main thing in this earnings season for us.
David, does it concern you at all just the extent that we are now so focused on AI? It so dominates the conversation. I just wonder, what would happen if the Mag 7 or really even just some key AI giants, if they faltered, what would that mean for the overall market?
I think it is a concern. Of course, it's a concern. AI is not just driving the markets, it's driving the economy. If we look at the AI investment as a share of overall business investment, it's very high. That business investment itself has been a key driver of growth. So the thematic concentration we see in the economy is very high. And then, of course, if you add in not just the AI exposure in liquid markets, but also how focused many private markets are on the AI theme as well, I think it is concerning, and it is a key risk factor to try to control. At AlphaCore, we specialize in placing alternative investments at the core of portfolios. And one thing that we are very keen to ascertain right now is the scale of the AI kind of importance in the private investment, so we know that we're not overdoing it given the focus of the in the public markets. But I would say that there are some powerful themes also around AI that are not directly related to it. For example, the rise of military spending around the world, the continual fiscal support we see around the world, the breakthroughs in healthcare, for example. And I think you see us playing some of those as well. So I know that all the focus is at AI, but there are other things going on, and we certainly like to make sure we have exposure to those to balance out the focus on this artificial intelligence revolution that we're seeing before our eyes.
David, great to have you on the show today. Appreciate your time.
Thank you.
Coming up, how long will gold continue to glitter? We're talking with an expert on its descent and whether you should get in on the precious metal. That and a whole lot more coming up. With investors keeping a close eye on Wall Street's reaction to the upcoming earnings season, Yahoo Finance's Jared Blikre breaks down the basics of analyst talk.
Let's face it, Wall Street loves its jargon, and reading an analyst note on your favorite stock can be a major head scratcher. With earnings season kicking off right now, we're decoding Wall Street analysts speak on today's Stocks in Translation. And let's start with a quick definition of analyst report. It's a research note that lays out an outlook on a company over the next 12 months. It usually includes a rating and a price target on the stock, and it breaks down risks as well as assumptions. It will also highlight what's changed versus the last note and whether their estimates move up or down. An analyst might have a positive, negative, or neutral view on a stock, but you're going to see different ways of stating that opinion based on the point of view. Here, if they're writing from the standpoint of what to do with the stock, it might be as simple as buy, hold, or sell. Then they might write from the perspective of how much weight the stock should have in your portfolio. They'll say overweight for bullish, equal weight for neutral, or underweight for bearish. Then sometimes they might take the view of how the stock is expected to perform versus a general market benchmark like the S&P 500 or the stock sector. So for a bullish opinion, they'll use the term outperform. For a neutral stance, it's market perform, and for bearish, it's underperform. And when they change their opinion or stance, they'll generally say upgrade if they got more bullish or simply less bearish, or downgrade if they got bearish or just less bullish. If they're starting to cover a stock from scratch or after a long pause, they will use the term initiate. Now let's take a beat and break down the stock's price target, or PT as they say. Think of it as a simple spreadsheet output. Dozens or even hundreds of numbers are going to go in and one comes out. It's not a promise, it changes when the inputs change. And most price targets are in a 12-month view unless the note says otherwise. And remember that they're not trying to time the market. This is big picture, long-term thinking. Many times they'll lay out a bull case and a bear case as well as their base case. They should tell you their confidence in these scenarios as well as a risk. And a wide range of possibilities, that simply highlights uncertainty. Always take note of their assumptions, whether it's margins, multiples, rates, or growth drivers. What are the dials that move the numbers? Now let's address some common misconceptions. Sticking with price targets, a new one doesn't necessarily mean they've got a brand new thesis. Read why they moved the target. And if the stock price hits that target, it is not necessarily a sell signal. Many times, an analyst will end up chasing the stock price. And for timing signals, the separate field of technical analysis, that can help you out there. And keep in mind that one analyst rating is just that, one viewpoint. For a broader perspective, we track the consensus opinion by taking the average or median of all the different street views. And neutral, it doesn't necessarily mean bad. Sometimes a stock is just fairly priced after a run. Now let's break down the bullish tells versus the bearish ones in those notes. On the bullish side, a raised estimate or higher price target with new facts is real fuel. Higher profit margins or new drivers of cash flow can be a quality upgrade. Cash is key, and it pays for buybacks, dividends, and debt. And how clear is the roadmap for the company? Are the factors that matter easily identified, along with milestones to note any progress? You want the ability to track specific things on a timeline. And on the bearish side, watch out when an analyst lowers its estimate for key numbers or moves key milestones into the future. That's saying less earnings or later, which usually deserves a lower price today. And if an analyst's thesis hinges on one-offs or hope, that's fragile. Hope is not a strategy, and fixes, they need evidence. And finally, if the analyst is signaling that some of the company's vital signs are deteriorating, like users, orders, or cash conversion, that means the health is slipping. Bottom line, don't get too fixated on the ratings label or the target. Understand the assumptions and what has changed, and follow the trends. And never let jargon drive your decisions. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website, or wherever you find your podcast.
Gold still shining, hitting fresh record highs and pushing above 4,100 an ounce. This comes as President Trump floats more potential tariffs and investors flock to safe havens. But our next guest says the rally, it's more about fundamentals than fear. Joining me now, we got David Miller, CIO and Senior Portfolio Manager at Catalyst Funds. David, great to see you as always. So first big picture, let's talk about what's kind of just driving this run in gold. You put it like this, David, you say the move to all-time highs isn't just about fear, it's about fundamentals. Explain that for us, David. What do you mean?
Well, so it's certainly not just one thing. So I guess to start, an easy way to think about it would be those China tariffs you just mentioned. If you think about it, if you're China and you're running the Chinese central bank and you own 760 billion of US treasuries, and you just saw that the US was threatening 100% tariffs, and you saw that back in 22, the US seized 300 billion of Russia's dollar-denominated assets, you'd probably feel a lot safer if you held 760 billion of gold bars in a vault in Beijing that we couldn't take at the flip of a computer switch. So that's probably a starting point, is you have these price-agnostic buyers, and it's not limited to China. They're not the only people we put tariffs on or indicated that we may not agree with their policy and don't want us to have that leverage. So they're an enormous buyer, over 1,080 metric tons last year, and they'll likely do more than that this year, meaning the central banks, particularly of the BRICS nations.
Central bank buying, it's an interesting trend to watch. Is that in and of itself, David, enough to keep gold moving higher?
Absolutely. The central bank buying is enormous because if you think about it, the US dollar as the world's reserve currency fundamentally started to shift after that weaponization of SWIFT in 2022. And then it really just poured gasoline on that fire when you added the tariffs to it earlier this year.
What about U.S.-China trade tensions? I mean, you saw that caused a freak out in the markets on Friday. What role do you think that's playing here?
I think that's pouring even more gasoline on the same fire. So, there's already this concern. We already had these tariffs earlier. We already had specific Chinese sanctions. So any addition to that just makes people want to transition off the dollar faster and buy more gold as a reserve asset.
Let's put some numbers on this. What are your gold targets? What do you pencil in?
So it's obviously been moving pretty quickly. We just got over 4,000 and now it's not too long ago than starting to crack 4,100. I think middle of, probably end of this year, you're probably looking 4,500. You could even see 5,000 plus a year from now. A lot of it obviously depends on those fundamentals and how they shift over the next few months and year.
For gold investors who are listening right now, what are, David, near-term risks you would emphasize that they need to have on their radar?
So obviously the price has obviously moved a lot. So whenever you see an asymmetric move like that, there's always the risk that it will retrace. I think the reason that's less of a risk right now is we have the Fed lowering interest rates. That's generally good for both bonds and gold. You also have the central bank buying. That's generally accelerating. So that's also pretty good for gold. Obviously, if either of those were to flip and they flip to raising rates or they flip to central bank selling, that would shift it. But there's no indication that either of those two are likely to happen. And then you also have deficit spending, which is the other big driver, which is also weakening the dollar because when you have 37 trillion in debt outstanding and you're running a $1.9 trillion deficit that was kind of enshrined into law in the big beautiful bill, those factors are very structural. So obviously if any of those shift and they flip to selling or they start raising rates or we see the government decide to run a balanced budget and create a new bill that reverses previous ones, that could change. But I don't think that's terribly likely in the near future.
So those are near-term risks. Would there be some potential near-term positive catalysts? Would it be like the next FOMC meeting?
Certainly. So, if the Fed decides that they're going to loosen policy and cut rates more than they've already indicated, that would certainly be a net positive for gold. If they decided that they were going to cut less or not cut, that wouldn't help gold prices. And you can think of gold in relation to the dollar from that perspective. Whenever the dollar weakens, that's a big net positive for gold on a relative basis.
What have gold ETF flows been like?
So gold ETF flows had been flattish the past couple of years in spite of the rising price, whereas year to date they've really started to take off in a much more significant way. They're not nearly as big as the central bank net buying, but that's an additional part of that cycle. The price escalation has attracted more buyers. It's certainly one of those situations where it's kind of a bit of the opposite of the store sale. People like buying gold more when the price goes up, ironically.
When friends and family come to you, David, they say, how do I get exposure to gold? What's the smart way? Do you say physical gold? Do you say ETFs? Do you say miners? Do you say all three?
So I think all three could have their value. So we've kind of approached this on our own. So we've created one ETF. It's called the GOLY ETF, Gold Enhanced Yield ETF. And what that does is it buys gold futures because gold itself doesn't pay a yield, but gold futures do deliver the price returns of gold, but it frees up the rest of the money in our fund that we can put it to work, generating income in investment grade corporate bonds that throw off a 5% yield to maturity. So we can stack that 5% yield on top of those price returns that we're getting from gold futures. That's been great for our fund. It's been up over 50% year to date. You can also own the physical. That's certainly the cheapest way to do it from storage cost perspective or management fee perspective. But then you have the risks of selling it. You usually have to sell it at some type of discount. And you're paying a premium when you buy it, whereas that's not really true in the futures markets or when you buy an ETF. Aside from the ETF route, though, gold stocks have gotten considerably more attractive because gold stocks really trade off of their margin. And when you think about it, over the past few years, gold prices had gone up, but their margins hadn't really improved significantly because the costs associated with gold had gone up with it. That really started to change this year as their margins really started to widen in a significant way because the gold rally has been much more significant than any costs associated with mining gold so far in 25.
Final question, David. I'm just curious, what would you have to see? What would need to happen to really kind of weaken your fundamental constructive view on gold? What's the headline where you would say, okay, that's a sell signal?
So we started to have some of those earlier this year, although they reversed. So, earlier in the year, the government was talking about Doge and what they were going to do to cut deficit spending and cut $2 trillion off of spending. And that would clearly be a net positive for the dollar, and that would be a net negative for gold. Now, they didn't follow through with that, but if they decided to reverse course and try to do massive Doge type cuts, that could certainly have an impact. If you had the government say, hey, we're going to drop all these tariffs, we decided we're going totally for free trade, that would be a net negative for gold, although that doesn't seem to be the trend right now either. Or if you had the Fed reverse course and say, hey, we're actually going to hike by 50 bips over the next few months.
You're outlining what sounds like some pretty low probability events.
And that's, I think, why gold's been rallying, because you have all these factors that are tailwinds all working at the same time.
Yeah, David, always great to see you, especially on set. Thank you, sir.
Oh, thank you.
Time now for what to watch Tuesday, October 14th. Starting off on the earnings front, big banks kicking off another earnings season on Tuesday, including JP Morgan, Wells Fargo, Goldman, and Citi. JP Morgan announced the results for the third quarter before the markets opened. Analysts expecting the largest U.S. bank by market cap to post strong Q3 results driven by trading and wealth management, but it's also facing higher costs and a lower rate environment that could shape its 2026 outlook. Taking a look at the Federal Reserve, we're going to be getting more Fed commentary on Tuesday, including Fed Chair Jerome Powell. Investors will be listening closely for any clues on the path of interest rate cuts, especially as the government shutdown enters its third week, causing the Bureau of Labor Statistics to delay September's CPI report. And checking in on small businesses, the NFIB Small Business Optimism Index is coming out on Tuesday. Economists forecasting that number to fall slightly to 100.6 in September, signaling sentiment among small business owners weakened marginally on a month-over-month basis. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.